He was, by reputation, the most trusted man on Wall Street, a former chairman of the NASDAQ stock market, a pioneer of the electronic trading the whole industry now runs on. His investment fund didn't chase the market. It simply went up, month after month, year after year, in booms and in crashes. Around 1% a month, almost without a single losing month for decades. Nobel laureates trusted him, banks trusted him, charities handed him their entire endowments. By the autumn of 2008, his clients' statements said they held $65 billion. There was just one problem with the greatest investment record in modern history. The trades never happened. Not some of them, not for one bad year. None. For at least 13 years, the fund bought essentially nothing at all. Every statement, every gain, every confirmation slip was printed out of nothing, 2 floors below a real and legal empire. So here is the forensic question. How do you steal tens of billions of dollars for decades with the regulator walking into your office and walking back out empty-handed? This is the story of Bernie Madoff and the most dangerous lie on Wall Street. Not a number, a reputation. To understand the largest Ponzi scheme in history, you have to understand it was built by an insider, not an outsider. Bernard Lawrence Madoff founded his firm in 1960. With $5,000 he had saved working as a lifeguard and installing sprinklers. It was a real business, and a serious one. He helped build the electronic plumbing that replaced the shouting men on the trading floor. Madoff was an early champion of computerized quotes, and his firm became one of the largest market makers on Wall Street. He was so respected that he served 3 terms as chairman of the NASDAQ stock market. His offices sat in the Lipstick Building on 3rd Avenue in Manhattan, an oval tower of red granite. On the 18th and 19th floors, the legitimate business traded real stocks for real clients. On the 17th floor, behind a locked door, was something else entirely. A separate investment advisory business, run by fewer than 24 people, that managed money for the rich and the connected. You could not simply call and invest. You had to be invited, and being turned away only made people want in more. He paid steady, unspectacular returns. He didn't promise the moon, he promised something better, safety. To his investors, Bernie Madoff wasn't a gamble. He was the safe place you put the money you could not afford to lose. That trust was not a side effect of the fraud. It was the entire mechanism. When clients asked how he did it, Madoff gave a plausible answer. He called it a split-strike conversion. In theory, you buy a basket of large, safe blue-chip stocks, and you wrap them in options that cap your losses and your gains. It was a real strategy. Conservative, boring, the kind of thing that should earn a steady, modest return. And Madoff's results looked exactly like that. A smooth line climbing gently upward almost forever. One of his feeder funds reported almost no losing months at all, year after year after year. On Wall Street, that is not comforting. That is impossible. Real markets are violent. They lurch and crash and recover. A line that never shakes isn't calm. It's drawn by hand. The warning sign was never the size of the returns. It was the smoothness. But smooth is exactly what frightened people in a frightening world want to buy. And Madoff sold it with a posture no salesman could fake. He acted like he didn't need your money. Advisors who asked too many questions were quietly cut off. The message spread, don't ask, don't tell. So the smart money stopped asking. The exclusivity did the selling, and the doubts began to feel like ingratitude. Behind the locked door on the 17th floor, the truth was simpler than any strategy. There was no trading at all. Here is how the machine actually worked. When new money came in, it did not buy a single share. It went into one ordinary checking account at a major bank. Investigators would come to know it by its number. The 703 account at JP Morgan Chase. Money from new investors went in. Money for old investors who wanted to cash out came back out. That was the entire engine. As long as more came in than went out, the lie could run forever. Everything else was theater, produced on the 17th floor by fewer than 24 people. A trusted lieutenant named Frank Di Pasquale helped run the fiction day to day. Staff picked which stocks should have been bought after the fact by reading what had already gone up. Then they printed statements and trade confirmations, dated for the perfect moment. The monthly high or the monthly low. They didn't predict the market. They reported yesterday's news as today's genius. An old IBM computer churned out the paperwork. Some confirmations even carried trades dated on weekends and holidays when the market was closed. It was, for a fraud of this size, almost crude. Paper, a printer, and a single bank account. And it held for years because nobody with the power to check ever actually checked the one thing that mattered. Did the trades exist? For at least 13 years, they did not. The most admired track record in finance was a stack of printouts. A lie this big needs a constant supply of fresh money. Madoff got it through a global network of feeder funds. These were funds whose only real product was access to Bernie Madoff. They gathered billions from around the world, handed it to Madoff, and charged their own clients fat fees for the privilege. The largest was Fairfield Greenwich, whose Century Fund poured roughly $7 billion into Madoff. There was Comed Securities, a firm Madoff part-owned, whose business was largely funneling clients to him. There were European banks. Spain's Banco Santander steered billions of its clients' money in through a single fund. Each layer added a comforting, respectable name on top of the void underneath. And each layer collected fees on profits that did not exist, from money that was already gone. The feeders had every reason not to look too closely. Their entire business depended on the returns being real. Madoff gave them steady numbers, and they gave him a river of cash, and nobody upstream wanted the music to stop. From the outside, it looked like the most diversified, blue-chip, conservatively managed fortune on Earth. From the inside, it was one checking account and a printer that never stopped. Not everyone was fooled. In Boston, a financial analyst named Harry Markopolos was asked to reverse engineer Madoff's returns. He later said it took him 5 minutes to suspect a fraud, and another 4 hours to prove it mathematically. The math simply did not close. Madoff claimed to be moving billions through options on the biggest American stocks. But Markopolos could see there were not enough of those options in the entire market to support what Madoff said he was doing. If the trades were real, someone somewhere would have seen them. Nobody ever did. In 2005, he handed the Securities and Exchange Commission a detailed memo. Its title left nothing to interpretation. The world's largest hedge fund is a fraud. He listed dozens of red flags. He all but drew them a map. The SEC examined Madoff more than once, and each time it walked away. Its own watchdog would later conclude the agency never once verified Madoff's trades with an independent third party. They had the most respected man in the industry sitting across the table, and they took his word. And Madoff turned their failure into his greatest sales tool. He told nervous investors the truth, twisted into a shield. The SEC has examined me and found nothing. Every Ponzi scheme dies the same way. It runs out of new money. In 2008, the financial crisis hit, and Madoff's investors needed their cash back. By that autumn, requests to withdraw reached about $7 billion. Madoff had a few hundred million left. The river of new money had finally run dry. On December 10, 2008, he called his 2 sons into his apartment and told them the truth. The business, he said, was all just one big lie. Basically, a giant Ponzi scheme. His sons, who worked in the legitimate side of the firm, listened and then called the FBI. The next morning, December 11th, agents arrived at the Lipstick Building and arrested him. An agent asked if there was any innocent explanation. Madoff said there was not. The number he first gave was $50 billion. The statements would put the paper figure at 65. But that 65 billion was mostly invented profit. Gains that had never been earned on trades that never happened. The real money, the actual cash that walked in the door and vanished, was around $17.5 billion. Still the largest Ponzi scheme United States authorities had ever seen. There was no trial. On March 12, 2009, Bernie Madoff pleaded guilty to 11 federal felonies. There was no plea deal. Standing in court, he admitted what the 17th floor had always known. He had never invested his clients' money in the securities he had promised. Not once. On June 29, 2009, he returned to be sentenced. Judge Denny Chin called the fraud extraordinarily evil and said no other case compared in its scope and its betrayal. He sentenced Madoff to 150 years in prison, the legal maximum. On paper, he was also ordered to forfeit $170 billion, every dollar that had ever flowed through the scheme. He was not the only one. His brother Peter, the firm's chief compliance officer, the man paid to guard against fraud, went to prison for 10 years. And the human cost ran far past any sentence. Less than 2 weeks after the arrest, a French financier who had funneled over $1 billion of clients' money to Madoff took his own life in his Manhattan office. exactly 2 years after his father's arrest. To the day, Madoff's son Mark took his own life. His other son, Andrew, died of cancer in 2014. Madoff himself died in a prison hospital in 2021. He had served about 12 years of his 150. Most victims of a Ponzi scheme get back almost nothing. The money is gone, spent, vanished. Madoff's victims were different because of how the cleanup was done. A court-appointed trustee named Irving Pickard ignored the fake account balances entirely. He asked one question of every account: did you take out more than you put in? Those who had pulled out fake profits were sued to give them back, so the money could go to those who had truly lost. In a single settlement, the estate of one investor returned $7.2 billion, the largest forfeiture in American legal history. In the end, more than $14 billion went back to victims, roughly 70 cents on the dollar of what was actually lost. And the scandal rewrote the rules. Regulators forced money managers who hold your cash to face a surprise audit by an independent accountant. Another set of eyes, precisely the thing whose absence let Madoff run for decades. It was not a new crime. It was the oldest one. In 1920 in Boston, Charles Ponzi paid old investors with new investors' money and lost about $20 million in a single year. Madoff ran the very same trick. He just ran it for decades under the most trusted name on Wall Street. Because in the end, he never sold a strategy or a stock or a single real trade. He sold trust. And that is the one thing nobody thought to audit.